Hey guys, Adam Rose, Vice President and Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today's another episode of the Mortgage Guy Podcast, and today we're going to discuss just a quick market update on rates and what's happening, and we're going to talk about zombie mortgages and how it's kind of starting to come back a little bit. I'll explain what they are, and the words "coming back" is loosely used. It's not like it's a specific loan product or anything called a zombie mortgage or anything like that. But we're going to teach you about it, especially it might be relevant to you investors out there that are looking to buy homes in cash or trying to find a deal, HUD homes, whatever it might be. Might be something to make sure you're doing your research on. Anyways, so mortgage rates, we know we've talked about it in the past couple of weeks. Rates have been moving. They've been moving downwards over the last 18 months. They've dropped about 1.5 points, roughly, right? But mortgage rates did tick up this past week just slightly, about 4 basis points, not a ton, but nonetheless, it's just kind of showing what's going on, how, we get these dips and they bump back up and they dip back down, they bump back up. But there's just a lot of data out there that impacts mortgage rates more than just the Fed coming out and saying, hey, we're cutting rates, right? It doesn't quite work that easily. But a quick note from Freddie Mac here. So the weekly average rate on a 30-year mortgage rose to 6.12%, the first increase in 7 weeks. The rate ticked up from 6.08 last week. A year ago, the average rate was 7.49. And the average 15 years is moving around a little bit too. So no big deal. There's not a ton of 15-year products going on out there. Yes, everybody still has them available. But I'll tell you what, the pricing hasn't been great on it. Honestly, looking at a 30-year and then doing some extra payments kind of makes more sense when you look at the numbers. So take a look at that. If you talk to your lender, you're looking at a refinance and you want to cut your term, there could be some other more beneficial options out there financially that could make sense. So take a look at that. So comments from the chief economist over at Freddie Mac. The decline in mortgage rates has stalled due to a mix of escalating geopolitical tensions, like I mentioned. Right? It's not as simple as the Fed cutting the rate and everything just makes, everything's great again. It just doesn't quite work that way. So geopolitical tensions and a rebound in short-term rates that indicate the market's enthusiasm on rate cuts was a little premature. We talked about that too. The Fed announced back in July that they were looking at doing a Fed rate cut, even though that was 2 months prior to them actually doing the cut. So they were kind of getting ahead of themselves a little bit on the data. Jobs reports numbers play a role. There's a lot of stuff that kind of plays a role. The consumer price index. So they were kind of anticipating that was going to improve a little bit more, but they kind of went on the record and said, we're going to do this. And I don't think they care what the numbers look like. That could have impacted this slight bump up after this drop that they put in place. More comments. So zooming out to the bigger picture, mortgage rates have declined 1.5% over the last 12 months, but home price growth is slowing, okay? It's just saying that if you bought your house, in January of this year, of 2024, 6 months later, it's not going to be worth, if you bought it for $100,000, it's not going to be worth the 150, all right? So the growth of the value is starting to just pump the brakes a little bit. The appreciation is going to start to slow. It's still there. All right, still going up in value. It's just not as quickly. Inventory is starting to increase. So let's talk about that. New inventory, I talked about this last week. New inventory in the market isn't keeping up with demand. All right, plain and simple. There's not enough builders building. There's not enough projects going up. That's just the way it is. It's not going to fit or fill that housing need, that demand that we have out there in the market for it. But they're saying inventory is increasing. Right. So what they're looking at is the average time a home sits on the market. Right. We went from in 2019, we technically had a housing supply for like 4 to 6 months out. We were okay. Now the housing supply, so homes were sitting a little bit longer, showing that the amount of demand out there wasn't meeting the supply needed. Right. So homes would sit for 3 or 4 months, maybe up to 6 months before they actually sold. That was a pretty normal market back then. But we got so used to 2020, 21, 22, even now, right? Especially when rates went down in 20 through beginning of 22, homes didn't sit on the market for 24 hours, right? So if you weren't ready to pull the trigger, you were going to miss out. Or if you didn't have cash, you were going to miss out. If you didn't go over the ask, you were going to miss out. Homes, if you look at the market, they're sitting just a touch bit longer, right? Some homes are still disappearing in 48 hours, 72 hours over the weekend. Some are sitting just a touch bit longer, maybe because of price point. There's a lot of talk about rates continuing to slide, so some people could be pumping the brakes a little bit more. But they're sitting just a touch bit longer, and there's a lot of factors that can play into that. Of course, you can't just broad brushstroke it because everybody's a little bit different. But that's what they mean by inventory is increasing. That means the houses are sitting on the market just a little bit longer. And incomes continue to rise. As a result, the backdrop for the home buyer this fall is improving and should continue to improve through the rest of the year. So like I mentioned in past podcasts, I do believe that in December that based off what's going on in the market, we anticipate another cut. All right. I don't know if that's going to happen. A lot of things can change that. We have the election coming up in November. So the month of October is going to get a little rocky. All right, we're going to see any talk, speculation, political stuff, polls going on. Polling numbers can play a role and kind of impact what's going on in the market. There's a lot of stuff that's going to happen. The month of October is going to be a little rough in regards to locking in rates because today it could be at 6, tomorrow it could be at 6.25, the day after that could be 5.875. I mean, it's just all over the map. Okay, it's just moving a lot. So FYI, when you do get pre-approved, always keep that in the back of your mind that, if I find a house 2 or 3 weeks from now, rates could be slightly different. Do I expect a massive difference? No. I don't expect a 1-point swing or anything like that. But your eighths, your quarters, that's very possible. So don't freak out if that was to occur to you. So what I wanted to get to were the zombie mortgages. The reason I even brought this up, a state attorney general forces mortgage servicer to cancel $10 million in zombie second mortgages and pay $300,000 equity penalty. That makes no sense, but whatever. Pay $300K. So in Massachusetts, the attorney general's office reached a settlement with Franklin Credit Management Corp over its practice of resurrecting zombie second mortgages or old defaulted loans without proper borrower communication. Settlement requires Franklin Credit to stop collecting on its Massachusetts loans, erasing over $10 million in mortgage debt, and pay $300,000 towards a penalty. Franklin Credit violated state regulations by delaying notices to borrowers, leading to unaffordable balances. So, what is a zombie mortgage? In essence, a zombie mortgage is a second. Okay, it could be a HELOC, closed-end second. What a piggyback loan? So, like a piggyback loan is when you buy the home. Right, so let's say you're wanting to do 20% down, but you don't have the full 20%. You're doing 80, 10, 10 or something like that. So 80% loan to value. You do your own 10% down, and then you got to piggyback for 10% more, which is a second mortgage, right? Some people will do that to avoid PMI. I don't know if it makes sense to do that because PMI is really not bad in regards to price point or cost. It just kind of depends on your risk profile. But anyways, that's what a zombie mortgage is. So how can they resurface? So, and what happens, right? They talk about clerical errors, people not recording them properly. Bankruptcy, that's probably the biggest one. Homeowners automatically think they file bankruptcy and then these things go away. So let's clarify a little bit. Student loans, you can't. They don't go away, buddy. That's a federal debt. Good luck with that. You're going to have that for the rest of your life. So mortgages, though, you either have to reaffirm or include in, okay, to try to get them paid. Make sure your attorney is on top of things because that is common to see that they thought they were discharged from their bankruptcy and they had a second mortgage. It wasn't included, whatever the case is, and it's still hanging out there. Lenders not writing off debts. Okay, so let's talk about that. So let's say you own your home, okay? You got a HELOC years ago. And you defaulted on the HELOC, but the HELOC wasn't large enough. They couldn't really go after you because they were in second lien position. Foreclosure notice means that the first mortgage position is going to take precedence, and they were going to sit there. They were going to be holding the bag, right? They're not going to get any money, so they just stopped sending you notices. But it's still there, right? But maybe that mortgage company never wrote it off as an actual loss and took a loss on their books for that year. So it could still be out there, and what's happening is it's sitting there accruing interest. All right, how it's found. So whether you're refinancing or purchasing a house, this could really mess things up. Title company does a search, and they see this second mortgage that was recorded 2017, for example, 7 years ago, and it never shows a release filed. So we start asking questions. They inform your lender, and they say, hey, we got this hanging out there. It's a lien against the property. And they usually are going to reach out and see if they can get a payoff on it. Well, you were like, well, I have no idea. That was in my bankruptcy 5 years ago, and I thought it was gone. Or, hey, I stopped paying that. I didn't get any balances. I thought it was paid off. And then all this time, it was sitting there accruing interest and fees and costs, all kinds of stuff. And so mortgage companies just stopped sending you notices, and they just left it hang out there, right? You as a home buyer, it's still your responsibility, right? But the lender's got to take some as well because they stopped sending you notices. They stopped trying to collect the debt, whatever it is. So there's a two-way street here. But what's happening is these are coming back to light a little bit more. Second mortgage holders are holding on to them longer, okay? And the reason they're doing that is because the appreciation of values since 2020 has been huge. So they know at some point that homeowner is probably going to want to refinance, cash out. They're going to sell it and try to make money. And then they're going to show up and say, look, you still owe 30 grand on this puppy. So it can throw off your transaction a little bit because you might be selling a house and you're selling it for 200 grand, you owe 150 on it, and you think you're going to make X amount of dollars, and then here comes this $30,000 second that you forgot about. So that can really upset the apple cart and may stop the sale of your home from happening. If you're a purchaser from your end, it shouldn't impact you, but a seller could possibly back out and break your contract. Now, the only way you're going to be able to go after them for that is litigation. So that's why people do it. But yeah, so it can mess up a purchase. It can mess up a refinance. And we got to pay. That's why we also pay attention to bankruptcy documents. If we see a bankruptcy on your credit report, even if it was 6 or 7 years ago, we may ask for some documents just in case there was something hanging out there. We'd like to make sure we don't get any surprises the farther into this loan we get. So pay attention to this, guys. If you do have a second in the back of your mind and you just don't recall what happened with it, it might not be a bad idea to do a little bit of research on it, especially if you're planning on refinancing sometime, cashing out, purchasing something else, selling the property, what have you. Okay. For investors is a big thing. So a lot of investors like to go sheriff's auctions and foreclosed properties, distressed homes, stuff like that, and try to get a good deal. Great way to go about it, right? It's a great plan, great strategy, but you got to be careful. I always suggest if you are an investor, a real estate investor, that you have a title company or an attorney in your back pocket to say, hey, I'm looking at 123 Main Street, and I think I'm going to get a good deal on this. Can you take a peek at the title on this and do a little search for me? I'd appreciate it. Whatever the cost is, they range from $200 to $300 to do a title review, just to pull some documents. A lot of it's public, right? So you can, it's all public, but a lot of it's online. It just depends on your county. Sometimes they have to send an examiner to the county where it's recorded and have them take a look, right? Because there could be something hanging out there still, and then have the title company make contact with them because you might think you're getting a deal for 40 grand so you can flip a home or rent it out or whatever it is. You're going to get it fixed up, and then you get a surprise of a $10,000 or $15,000 second or like a zombie loan, right? Or zombie mortgage, tax liens, Medicare liens, Medicaid. You just got to be careful, all right? It's the same concept, looking at all the title work in the past, just to make sure there's nothing outstanding against it, and you're getting a good deal, because it can be a bad surprise and change the whole aspect of the transaction. So I hope that information was helpful, guys. Again, subscribe on YouTube. Check us out on Apple Podcasts and Spotify, and we will see y'all next week.